You could send $80,000 to your mortgage company tomorrow, mark every dollar to principal, and your required monthly payment would not drop by a single penny. You would owe less and finish sooner, yet the bill next month stays identical. Almost no homeowner knows that. There is a quieter move that does lower it. My name is Eric, and on this channel, I read the fine print on the money decisions that hit older Americans, so you can make your own call with your eyes open. Today I am going to walk you through 4 things. Why sending a big lump sum to your mortgage does nothing to your monthly payment. What a recast really is, and the exact rule in the servicing rulebook that makes it work. Who gets to use it and who does not. And how it stacks up against the thing most people reach for instead, a refinance. Then I will hand you a short list of questions to take to your own servicer. This is the difference between a payment you dread and $500 a month back in your pocket, so it is worth 12 minutes. One promise before we start, and I mean it. Nothing in this video is a plan for your specific loan. I am going to show you how the machine works, in plain English, with real numbers. What you do with your own mortgage is a conversation between you and someone who can see your actual file. So let us build it from the ground up. Start with the piece almost nobody believes until they watch it happen. On a normal fixed-rate mortgage, your principal and interest payment is set the day the loan is written, and it does not move for the life of the loan. The Consumer Financial Protection Bureau puts it in plain words. With a typical fixed-rate loan, the combined principal and interest payment does not change over the life of your loan. What changes, month by month, is the split inside that payment. How much goes to interest versus how much goes to principal, not the size of the payment itself. And in the early years, that split is brutal. Take a $400,000 loan at 6.5%. The monthly payment runs about $2,528. In the very first month, around $2,167 of that vanishes into interest, and only about $361 lands on the balance. That is why, 5 or 6 years in, you can look at your statement and feel like the balance has barely moved, even though you paid faithfully every single month. Most of your money has been feeding interest, by design. And that split is not an accident or a mistake you can argue your way out of. It is written into the amortization schedule the day you sign, a fixed table that lays out exactly how much of each of the 360 payments is interest and how much is principal. The lender does not rerun that table just because you sent extra money. Your extra dollars get subtracted at the far end of the loan, quietly erasing some of the last payments you would have made years from now, while the payment sitting in front of you stays completely frozen. That is the whole reason a lump sum feels like it should lower the bill, and then simply does not. Now watch what happens when you try to fix that with a big check. Picture a composite couple, Ray and Diane, both in their 60s, drawn from common situations rather than real people. They just sold a small rental property, and they are sitting on $80,000 in cash. They still carry a mortgage on their own home, and like a lot of careful people, they decide to do the responsible thing and throw the whole $80,000 at the principal. And it works, in one narrow sense. Their balance drops by $80,000 overnight. They will pay the loan off years sooner, and they will hand the bank far less interest across the life of the loan. But the next statement lands, and the required payment is the exact same number it was the month before. Not a dollar lower. They just handed over $80,000, and their monthly budget did not move an inch. The money is locked in the walls of the house. They are further ahead on the loan, and just as squeezed every month as they were before. That is the trap, and it catches good savers hardest, because the people most likely to send a big principal payment are exactly the people who assumed it would lower the bill. So here is the move that changes the monthly number. The one your lender is not going to bring up on its own. It is called a recast, or a reamortization. And the first thing to understand is that it is not a new loan. You call your servicer, the company you send your payment to, and you ask them to reamortize the mortgage. Fannie Mae's own servicing rulebook describes exactly this. After a substantial principal curtailment, the servicer may agree to reduce the principal and interest payment based on a reamortization of the current unpaid balance, using the current interest rate and the remaining loan term. Read that one more time, slowly, because every phrase is carrying weight. They take your new, lower balance. They keep your same interest rate. They spread it back out over the years you have left. And out the other side comes a new, smaller required payment. This is paperwork, not a new mortgage. Fannie Mae handles it with a single agreement form. There is no new appraisal, no fresh credit check, no closing table, nobody asking for your pay stubs or your tax returns. Sit with how unusual that is. Almost every other way to lower a mortgage payment means qualifying all over again, proving your income, letting someone recheck your credit, waiting on an appraiser to walk your home. A recast asks for none of it, because you are not borrowing anything new. You already qualified for this loan once, and now you are simply asking the servicer to do arithmetic on a smaller number. And understand why your servicer does not lead with this. A servicer earns on the interest your loan throws off, so a smaller balance and a smaller payment is not news it rushes to put in front of you. That leads straight to the first rule you need to hold on to. A recast does not touch your interest rate, and it does not touch your payoff date. That same servicing rule ties the new payment to your current interest rate and your remaining term, which means you keep the rate you already have and you finish on the same schedule you were already on. The only thing that changes is the required monthly payment, and it goes down. Now think about who that matters to most. If you locked a mortgage a few years back at a rate near 3%, and today's rates sit closer to 7%, that low rate is one of the most valuable things you own. On a $300,000 balance, 3% costs you about $1,265 a month in principal and interest, while 7% on the same balance would run close to $1,996. That gap, more than $700 a month, is what your low rate is quietly saving you. A recast lets you lower your payment while keeping that rate completely untouched. Hold that thought, because in a minute, it becomes the whole reason this tool beats the obvious alternative. Now the rest of the rules. Because not every loan qualifies, and this is the part that decides whether the whole idea is even open to you. Rule 2 is that the loan has to be current. Fannie Mae's guidance covers reamortization for current mortgage loans, which means you cannot be behind on your payments and ask for this. Rule 3 is the one that quietly settles the whole question for millions of people. A recast is mostly a conventional loan feature, the loans backed by Fannie Mae and Freddie Mac. If your mortgage is insured by the Federal Housing Administration or guaranteed through the Department of Veterans Affairs, those programs generally have no reamortization provision at all. You can ask, but do not count on it. So the very first thing to find out is who backs your loan. Because if the answer is one of those government programs, this conversation may end before it starts. And finding that out is easier than you might think. Your monthly mortgage statement usually names the investor behind your loan, and if it does not, a single phone call to your servicer settles it. There are also free federal lookup tools that will tell you in about a minute whether Fannie Mae or Freddie Mac owns your mortgage. Spend that minute before you do anything else, because the answer decides whether the rest of this is a real option for you or just an interesting story. Rule 4 is about the price of admission, and here is where I have to be honest with you. There is usually a minimum lump sum and a fee. But the national rulebooks do not set either one. Fannie Mae's guide leaves the minimum and the fee entirely to your servicer. In practice, servicers often want at least a few $1,000s of principal before they will run a recast, and they often charge a modest fee, somewhere in the low hundreds of dollars. But because every servicer sets its own, the only number that means anything is the one your servicer quotes you. So you ask, and you get it in writing. And think about when a lump sum like this lands in a person's life, because it is more common in your 60s and 70s than you might guess. You sell the big family home and downsize, and the proceeds are sitting in the bank. An inheritance comes through. A pension pays out as a single lump. A business you built finally sells. In every one of those moments, the instinct is to throw the money at the mortgage. And in every one of them, a recast is the difference between that money easing your monthly life and just disappearing into the wall. Let me put numbers on all of this, and I want to be crystal clear that these are illustrative. Your loan, your rate, and your servicer will change the answer, so treat this as an example, not a promise about your bill. Go back to Ray and Diane. Say their original loan was $400,000. The rate on it is 6.5%. On a loan that size, at that rate, the monthly principal and interest payment runs about $2,528. A few years in, their balance has ground down to roughly $374,000. Then they send in the $80,000, and the balance drops to about $294,000. If they stop right there and do nothing else, remember what we said. Next month's required payment is still the same $2,528. But if they ask for a recast, the servicer reruns the math on that lower balance, at the same rate, across the years they have left. The new required payment comes out around $1,988. That is a drop of roughly $540 every month. Over a full year, it adds up to more than $6,000 back in their budget, for the price of some paperwork, and without surrendering their rate. For a household living close to the edge on a fixed income, $540 a month is not abstract. It is the Medicare supplement premium. It is the prescriptions they stopped splitting in half. It is the difference between a budget that feels tight and one that feels impossible. The lump sum finally shows up where they can feel it, in the monthly bill, instead of vanishing silently into the balance. This video is for educational purposes only and is not tax, legal, or financial advice. Talk to a qualified professional before making any decision about your specific situation. If this is the kind of plain English breakdown you want more of, take 1 second and subscribe, and tap the notification bell while you are there. That is the single thing that tells the algorithm to put this in front of the next homeowner who is about to send a big check the wrong way. And it costs you nothing. And if you want the one-page list of exact questions to take to your servicer, laid out so you can check your own loan, the link in the description has it waiting for you. Now let me get to the question sitting in your head, because you have been waiting to ask it. Is a recast just a refinance by another name? It is not, and the gap between the two is the entire reason this matters. A refinance also resets your payment, but a refinance is a brand new loan, with all the cost and friction that comes with one. Freddie Mac tells homeowners to expect to spend 3 to 6% of the loan principal in closing costs to refinance. Put that on a $300,000 loan, and you are looking at somewhere between $9,000 and $18,000 just to reach the finish line. And the closing costs are only half the friction. A refinance means a new application, a fresh pull of your credit, a new appraisal of your home, new title work, and often weeks of underwriting, while a stranger picks through your finances before anyone approves a thing. A recast skips every bit of that, because they are not revaluing your house and they are not making you a new loan. And then comes the part that should stop you cold. A refinance trades away the interest rate you currently hold and hands you today's rate instead. Remember that couple holding 3% while the market sits near 7%. A refinance would push their payment up by more than $700 a month and cost them thousands in closing fees for the privilege, all to borrow the very same money they already borrowed. If you are one of the people carrying an older, lower rate, paying to give that rate up is not a solution. It is a downgrade with a stack of paperwork attached. A recast does the opposite. It leaves the rate you are protecting completely alone. That is why, for someone sitting on a low rate, a recast is very often the only tool on the table that lowers the monthly payment without forcing them to surrender the one thing they should never let go of. Now here is where I have to level with you all the way, because a recast is a tool, not a magic wand, and there are real catches you need to weigh. The first one is the big one. A recast lowers your payment, but it does not, on its own, make the loan cheaper. When the servicer takes your lower balance and stretches it back across all the years you had remaining, you can end up paying more total interest than if you had made that same lump sum payment and simply kept paying the old, higher amount. Here is why, in plain terms. When the balance is respread over the full remaining term, more of your future goes back to being slow, interest-heavy payments, exactly like the early years we walked through. You lowered the monthly number, but you also handed the loan more time to charge you interest on the way down. For most people, it is not a huge difference, and the monthly relief is well worth it. But it is real, and you should know it is the trade you are making. Which points at the one idea worth carrying out of this whole video. Some homeowners recast to get the lower required payment as a safety floor, and then they keep voluntarily paying the old, higher amount anyway. Think about Ray and Diane again. Their required payment fell to $1,988, but nobody says that is the most they are allowed to pay. If they keep sending the old $2,528, that extra $540 a month drives the balance down fast and keeps their payoff on the quick schedule. And yet, the day a hard year arrives, a job loss, a medical bill, a rough stretch, they can drop back to the lower $1,988 with no phone call and no permission, because that is now the required amount. The low payment is a floor they can stand on, and the high payment is a choice they make when times are good. Whether that fits your situation is a conversation for you and an advisor who can see your numbers, not a decision I can make for you from here. The second catch is simpler, and I want to say it plainly. Do not drain your emergency fund to manufacture a lump sum. That cushion outranks a lower mortgage payment every day of the week, because the whole point of the payment relief is breathing room, and you do not buy breathing room by spending the air you already have. A common guideline is to keep 3 to 6 months of living expenses within easy reach before you tie up any cash in your home. And a recast, by its very nature, locks that money into the walls, where you cannot pull it back out without borrowing all over again. The third catch is about order of operations. If you are carrying credit card debt at 20% or more, that lump sum has a more expensive job to do first. Killing the costliest debt comes before feeding the cheapest one, and a mortgage, especially a low-rate mortgage, is usually the cheapest money you will ever borrow. So before a single dollar goes toward a recast, the high-interest debt gets handled. So here is your short list, and notice these are questions to ask, not things I am telling you to do. 1. Ask your servicer directly, does my loan allow a recast or a re-amortization? 2. Ask who owns or backs my loan. Is it Fannie Mae, Freddie Mac, the Federal Housing Administration, or the Department of Veterans Affairs? 3. Ask what the minimum lump sum is and what the fee is, and get both in writing. 4. Ask them to show you, on paper, what your new payment would be on your lower balance before you commit a single dollar. A servicer can usually quote a recast in a few minutes, so make them run your real number, what the payment falls to, and what the fee is to do it. If they tell you the fee is around $250 and your payment would drop $300 or $400 a month, that is a small, one-time fee paying for itself inside the first couple of months. And if they tell you your loan does not qualify, you have your answer, and you have lost nothing but a phone call. And 5. Take those numbers to a housing counselor approved by the Department of Housing and Urban Development, or to a fee-only advisor, and weigh 3 honest paths side by side. Recasting, keeping your payment where it is and just paying down principal, or refinancing, against your actual budget. And do not skip that 5th step. The math on a recast is simple, but the decision around it is not, because it touches your rate, your total interest, your emergency fund, and your other debts all at once. A good advisor can weigh whether that $540 a month of relief is worth more to you as monthly breathing room or as a faster payoff. And the honest answer is different for a couple with a full emergency fund and no other debt than it is for a couple with a thin cushion and a credit card balance sitting behind them. Same tool, 2 different right answers, and only your numbers decide which one is yours. The right answer is the one that fits your numbers, and those are numbers only you and someone looking at your file can truly see. Here is the whole thing in one breath. Sending a lump sum to your principal does not lower your payment. A refinance lowers it, but it costs thousands of dollars and takes your rate with it. A recast reruns the math on your lower balance, keeps your rate, and hands you a smaller required payment, for the price of some paperwork and a fee in the low hundreds of dollars, not the $9,000 to $18,000 a refinance would cost. Next time, I am going to show you the escrow surprise that can quietly push your mortgage payment right back up even after you have lowered it, and how to see it coming a full year in advance. So let me ask you this, and answer in one word in the comments, yes or no. If your servicer said yes, would you recast? I read every single comment, and the most common questions become future videos. I will see you in the next.